All right, people. So now let's do a little practice. So right here we have three activities for a company, and that just all happened in January. And what we do here is just follow the protocol. We first analyze the transactions using the accounting equation, and the second we're gonna record the transaction in journal entry, and then last we're gonna use the T accounts to present the items on general ledger account. So basically, we do recording and then journal entries and then general ledger. So let's look at this event one by one. The first one, a person invested $4,000 cash in a company. So that's a 4,000 cash increase, and also on the other side of the equation, the equity increased by 4,000. And then if you record it in a journal entry, then you will see that cash got a debit. This is the assets when it increased as a debit, and also your equity represented by this owner's capital got an increase as well. So that's a 4,000 credit. And then if you post on the general ledger account, then you will see that two items are involved here. One is cash and another is owner's capital. So cash increase, that's a debit, and owner's capital increase, that's a credit. And also in later events or transactions, if anything related with the cash, it will be recorded in this journal ledger. And if anything related with equity or capital, it will be recorded under this ledger. The second event, the company purchased $2,000 of equipment on credit. So if you analyze it, you will see the equipment increase its value by 2,000. Does that happen? Does that have anything to do with your cash? The answer is no, because the equipment is not purchased on cash. Instead, it's purchased on credit. So what you shall see that the company has a $2,000 account payable. It is recorded on an accrual basis, which means the purchase is happening today, but the payment will be made later. On the record, you will see that equipment as the assets has increased, that's a debit, and accounts payable as a liability increase because and that's gonna be a credit. And then in the general ledger, you will see equipment got affected, so that's a 2,000 debit, and accounts payable got affected, that's 2,000 credit. And we always use this accounting basic principle. I have mentioned it multiple times in our previous example in the PowerPoint and also in our Excel practice. So this is something you always have to remember. Then the next transaction, the company provided $540 service to a client on credit. And this time it's not a cash purchase, it's not a cash got involved, it is still on credit. So what you shall see that the company earned a revenue of 540 for rendering its services, and also the company has account receivable being built up. Although the service done today, but you will be paid, you will get the paycheck in a later period. And today you just put that number on account receivable. So account receivable is an asset, that's definitely a plus for you, and equity is from the revenue you just generate. So on the record, the general entry here is that account receivable has a debit because it increased, and the service revenue have a credit because that's a part of equity, and it also increased. And on the general ledger, you will see the two accounts get affected. One is account receivable, and another is a services revenue. And the places for the number is the same as they are in the journal entry. All right, now we move down to the next level up. So we are going to prepare and explain a trial balance. So trial balance basically is organized from the accounts in general ledger. So here are the 3 steps we need to take. The first, we need to list each account title and its amount from the ledger we created earlier. And if account has 0 balance, then we just forget about it, just omit it entirely. And second, we're going to compute or calculate the total debit balances and the total credit balances. And then the last step actually is the verification. We're going to prove what we did is correct. So we have to make sure the total debit match the total credit. And here is the textbook example we did before. So there were a lot of going on with cash and account receivable got balanced out. The supplies got an increase. So whenever there's assets increase, that's a debit. And then you also have credit on the equity and liability side. Accounts payable is a liability, and that basically increase, so that's a credit. And here we'll see unearned revenue that belongs to equity, owner's withdrawal, and owner's capital are all belonging to equity, and withdrawal is basically a negative equity. We treat that as expense. And all the revenue here belongs to equity, those are credit, and all the expenses there are part of equity as well, but they are treated as negative equity, so those are debit. And then you just add up all the debits and all the credits all together. So this 45,300 is a summation of all the numbers in this column above the total. Likewise, this 45,300 is a summation of all the numbers above it. So the trial balance lists all ledger accounts and their balances at a point in time. So if the books are in balance, then these 2 numbers, total debits and total credit, should be equal to each other. And then we will enter the process of searching for errors. So if the trial balance does not balance, in other words, if your total debits by any chance does not equal to your total credit, so you need to take the several steps. First, you need to make sure the trial balance columns are correctly added, and also you need to make sure the numbers are correctly imported from the ledger accounts. And also you need to see if the debits and the credits are put in the right place. Did you put a credit on the debit place or vice versa? And then you need to recompute each account balance in the ledger just to do everything all over again. And then you're going to do the verification again, make sure the debits equal to credits in sum. All right, our next objective is to prepare financial statements. So we have analyzed a lot of activities. We are going to record all the transactions, put them in journal entries, and then organize them into a general ledger for under different accounts. And then we're going to put all these ledger accounts together to get a trial balance. And now, once we have the trial balance, we are going to develop financial statements. So the financial statements is made of 4 components, as I mentioned in chapter 1. So there's our balance sheet, income statement, statement of owner's equity, and a statement of cash flows. Well, the balance sheet items is occurring on the point in time. You can see you have the balance sheet at the beginning of the period, and also you have balance sheet at the end of the period. And these 3 statements like income, and your equity and your cash flows are all occurring during this whole period, a length of time instead of just at one specific time. So you should recognize that it is the change of the balance sheet from the beginning to the ending really contribute to the items, to the numbers in this statement of cash flows and statement of owner's equity. All right, so these are the basic definition of a financial statement. Income statement report revenues less expenses, and also it is for sure for a period of time. And the statement of owner's equity report how equity changes over the reporting period, and balance sheet is at a point in time. It reports a company's financial position, like how much money for total assets and how much dollar for total liabilities or equity. And the statement of cash flows report the cash inflows and the cash outflows. They do not report accounting items which got affected by non-cash terms. And here is an income statement we could make. You have the revenue on the top. You have service revenue, rental revenue, as mentioned in our PowerPoint example earlier. And you also have different expenses being deducted here, and you will organize your net income. And then you're going to put your net income all the way to owner's equity. So the net income is $33.95, and you have owner's equity being put there. You also have owner's withdrawals. So owner's equity and withdrawal plus net income is the ending balance for owner's capital. So this would serve as a total equity in your balance sheet. So on the balance sheet, you will see the total equity is placed here as part of the total liabilities and equity, and you need to combine liabilities here to get another new number for the sum, which is 42,395, and this will be exactly equal to the total assets being reported from all these 4 items mentioned in the transactions. And we also have some presentation issues. So we could have a dollar signs appear in the financial statements, and they also appear in the trial balances. And also we make sure the number of the units of a measurement should be identical. It's either thousands, millions. You have to use a uniform standard for all the numbers. And you need to put commas in the right place. So for every 1,000, you put a comma. And you should remember that commas are always used in the financial statements. And also there are some rounding issues. Do you get it to the nearest dollar or even to a higher level? Okay, so this is an example of Apple we did before. So right here, it shows Apple has different activities and resulting in different accounts change. So this is a trial balance you can follow. So basically, you need to sort your items into assets, liabilities, equity, owner's withdrawal, revenue, and expenses. And if there's a normal change, or let's say just assets are gonna appear or get purchased, so that's a debit because assets increase. And for liability change, when you borrow more money, that should be a credit, and so on and so forth. And then you're gonna put all the numbers in the right place. So cash, account receivable, and the land, they all belong to the assets. And also this investment and other assets is just another miscellaneous term under total assets family. And then you work on the liabilities. You have accounts payable and you have other liabilities. And then you have to make sure when these items change, those will be billed as a credit, okay, because they are liabilities. And for assets, when they increase, they should be billed as a debit. And then you also have owner's equity, owner's withdrawals, and also revenue being put in there. So you will see that these all items, after you add them together, combining our revenue and expenses, of course, will give you a total debit that is equal to a total credit. All right, so this probably reminds you the total balance for your balance sheet, where your total assets equals to your total liabilities and equity. We just put them all together instead of sorting the items as total assets versus total liabilities and equity. We sort them based on a debit and a credit, and eventually the debit and the credit would match each other.